Good morning, everyone. We've got a really robust audience this morning and some great presenters. So we want to get our 2023 Affordable Housing Program Feasibility and Application webinar started. My name is Theo Knoll. I'm the Affordable Housing Program and Outreach Manager, and I want to invite our Senior Community Investment Managers to introduce themselves. Kathleen. And yeah. All right. Kathleen, you should be unmuted. And
I am.
Mike, good. All right. Would you care to introduce yourself? And
you didn't hear us the first time? I'm Kathleen Amonte. I'm one of the community investment managers here, and my territory is Connecticut, Rhode Island, and southeastern Massachusetts.
Terrific. Toby?
Great. Good morning, everyone. I'm Toby Goldberg. I'm one of the other community investment managers, and my territory is Maine, northern Massachusetts, and eastern Massachusetts.
Wonderful. And our third community investment manager is Mike Pinkpenk.
Hi, everybody. I'm Mike Pinkpenk. I am in charge of the territory for Vermont, New Hampshire, Worcester, and everything west in Massachusetts, and all of the projects that come in from outside of New England.
Fantastic. And all four of us, as well as the rest of the team, are available to answer all of your AHP questions whenever you've got them. And we look forward to helping you through this application process. Today, we're talking about feasibility and need for subsidy. Just a couple other housekeeping items. In the handouts, you'll see PDFs of this presentation, our scoring webinar, our members only webinar, a PDF of our self-scoring worksheet, and a copy of the member analysis questions that we ask the members to do. I mean, they're very obviously straightforward and refer to how they regard the initiative and sponsor capacity as part of their analysis and potential underwriting of the project. In terms of housekeeping, there are two ways to ask questions. You can raise your hand, and I'll unmute you, or you can click on the, or you can type a question into the chat, and we'll step to it and answer your questions either as we go or at the end, depending on when we catch the question. We are recording this so that we can capture all your questions and generate a transcript. We do intend to post recordings of the webinars on YouTube, but we're gonna make that call based on how this session goes, if this is what we post, or if we do a separate recording. So please don't be shy with questions, comments, or other feedback about the AHP. Here's our quick agenda. We're talking about feasibility, which means sponsor capacity, readiness, feasibility, and need for subsidy. Many of you know the bank and know our organization. We are a wholesale bank providing liquidity and funding to our shareholders with the mission of supporting affordable housing and economic growth throughout New England and where our members do business. Diversity, equity, and inclusion is a core value of the bank and everything we do. And you'll see it in the Affordable Housing Program, our scoring question around inclusion. And we're happy to talk more about this as we go, but we really are committed to making sure that all of our programs, all of our activities really do take diversity, equity, and inclusion into practice. And we are interested in reaching out to sponsors and communities across New England. Here's the housing team. Many of you know us, and you can see myself and Kathleen, Toby, and Mike here. Really quickly, this year we've got at least $21.25 million of subsidy available. We do expect some additional de-obligations of prior awards to come back into the program. The biggest changes we've made this year is increasing the total subsidy per application from 650,000 to 1.2 million. Of that 1.2, 850,000 can be in a direct capital grant. And we've also increased the homeownership direct subsidy per unit from 40,000 to 75,000. And you'll see on this slide just some quick key points about the affordable housing program. It's competitive capital gap funding that comes in the form of a direct grant or interest rate subsidy that helps subsidize the interest rate on long-term debt that you would get through us, called the subsidized advance. Here's the online website and a link to our 2023 AHP implementation plan and our regulation. All of this, as you know, AHP is a regulated program with a lot of elements established in the regulation, certainly in terms of feasibility and need for subsidy. And we're going to talk about these core components in blue: readiness, sponsor capacity, feasibility, and need for subsidy. Our dates: the application opened last week on Monday, June 5th. Applications and all the data and documentation are due July 27th at 3 p.m. To the bank. And this is the sponsor's application deadline. We will give members an extra week to review the application and complete their portion of the application, uploading their documentation and completing the member analysis questions that I referenced. And all of that is due Thursday, August 3rd at 3 p.m. as well. As we all expect, fraud reporting is a critical element of, I think, every funder and everything we do. And it really is around preventing and reporting fraud, either intentional or unintentional. So please keep an eye out and please communicate to us as soon as possible in the event you have some questions. This slide demonstrates the 6 new feasibility elements that we're going to touch on this morning. We are breaking out the component costs of acquisition. Multi-phase developments also speaks to feasibility and need for subsidy because AHP funding is really meant to be solely for this application that you're doing. Resident services, we are going to ask you to break these out as an element of your housing operating costs. Again, that speaks to need for subsidy. And we've made some other changes to our feasibility guidelines. Most notably, we've increased the developer fee from 12.5% to 15% of your total development costs, net the total development fee. And that housing operating costs, the range we've increased to $6,000 to $10,000 per unit per year, reflecting in all of these changes, the increased subsidy, the higher development fee, the higher operating costs really are in response to the operating environment that you are developing affordable housing in your communities. So when we talk about feasibility and need for subsidy, the first area really is sponsor capacity. And this obviously makes sense. We need to know who the sponsor is and your track record and your staff and your ability to develop and operate your housing initiative successfully. And you can see here's the documentation that we're looking for. And all of this you've done or you're doing as part of your sponsor registration. New developers are welcome to apply to AHP. The real caveat is we do hope and require that you partner with a known development partner who has the experience to help you bring this housing to fruition and to help set it up for successful operations. And that we'd expect you to include an MOU or a letter agreement with that developer, that experienced partner, and that partner would be included as a co-sponsor. And you'll see this referenced in attachment A of our regulation, of our AHP implementation plan, as well as all of the feasibility elements we're talking about this morning. In terms of project readiness, at the time of application, there's really 4 things that you're demonstrating to us. First of all, that you have site control at the time of application. Moreover, in terms of zoning and funding commitments, we're expecting you to have all of this in place within 12 months of your AHP award so that your initiative really is able to continue to move forward. And you'll describe and document this to us. And all in all, we are expecting you to be able to draw our funds, ideally within that 12-month period, and get your housing fully built or rehabilitated within 36 months of the AHP award, and leased up or the homeownership units sold reasonably soon thereafter. So that's a quick run through of the affordable housing program and our changes to feasibility this year. And we're going to dive into developmental feasibility and operational feasibility now. And so I'm going to pass the baton to Toby. All right, and we cannot hear you, Toby.
There we go. Thank you, Theo. Sorry, we had to turn the mic on. Thanks, everyone. Good morning. I am going to talk to you about developmental feasibility, and really what we're looking at is your development budget, your sources, your uses, and construction budget. And like every other part of the application that you'll be doing for us, we're reviewing the information that you provide to us as compared to the supporting documentation that you upload. So on this screen, what we're really looking at is how you request our funding, as well as how do you upload your sources and uses. The blue box is your sources, the red box being your uses. As Theo mentioned, we're digging a little deeper into acquisition costs this year, so that there's a separate section for you to upload that documentation. Overall, what we're looking for is that your project needs our money. Subsidy is in short supply. It's a scarce resource, and you need to demonstrate that there's a need for the AHP subsidy, either as a direct subsidy, and if you're a rental project and requesting it, as a subsidized advance. Mike will be talking, I think, later about the operational feasibility, but on both sides, we're just really looking to demonstrate that there's a need for the money that you're requesting from us. Next slide. So how do you enter your member loans, right? You're coming, the Home Loan Bank is a cooperative, and all your requests are coming in conjunction with our member financial institution. So to maximize those points, you're going to be entering how they're involved in your project, be it construction financing, a permanent loan, a tax credit investment. So you're going to enter first, you're going to do your budgets before you start the application, right? You're going to have a copy of your current sources and uses. So you're going to be entering the AHP grant, and then you're going to be entering the member loans. And this is the screen that you'll be doing it. What you want to make sure of is that if it's a permanent loan, you're clicking permanent button, and that you have all of the information about the loan ready to load. You have the interest rate and the origination fees. And members, what we're going to be asking you to do is, once the sponsor submits their application, this is one of the screens you're going to be double checking. Sponsors, think about deadlines. If in fact you make a boo-boo in this section, the member won't be able to assign it if you wait till the very last minute to submit it. So plan ahead, be thoughtful and considerate of your member, and give them some time to double check the information, because it's all to your benefit. And we want to review your application with the most accurate information. So plan ahead and set up some fake deadlines for yourself, so you're giving the member time to review before the final submission deadline. So this information on the member loans and your AHP is actually going to be part of the table that you're building, your sources table. If you're entering a subsidized advance, it's a permanent loan, and it's one that you're using AHP subsidy to buy down the interest rate on, it's going to actually calculate within that worksheet that we just saw. And if the member is making the loan directly, that's great. And if there's an intermediary, as we see in some of the bond transactions or some of the states, then you're going to check this box here and let us know who the lender is going to be advancing the funds to and who the final loan is through. All of that is okay as long as you tell us up front that the project is still getting the benefit of the reduced interest rate. So it's really, our rate to the member, their spread, and then if there's an intermediary, what does that look like? All right, so next screen. So here's what it's going to look like as you start to enter your loans and enter the AHP. It's going to be this really cool table, and at the very end, you're going to see a total of all your sources. I know the screen's a little bit busy, but it's really pointing to all of the information that you need for each source of funding that you're requesting, whether it's a grant or a loan. You want to enter each source separately and then indicate whether it's all being used for residential, or if you have a commercial component, you're going to need to split that out. If some of it's going to the residential, some of it's going to the commercial. You're going to have to enter those on separate screens. If you're all residential, then I guess it's a little simpler, right? But you're going to enter the with how much the money, how much each source is, where it's coming from, when you anticipate what the rates are, the term, any origination fees, and when it's the commitment date. And so you're going to need that for each one of your sources. And that's why I say build your budget ahead of time, have this all worked out so that it all matches and is consistent throughout. We know that budgets change, but you need to pick a point in time and then stick to that point in time throughout your entire application. Next slide.
Yep. Before we go to the next slide, those two red arrows, the type of the source is a drop-down list, like equity loan, deferred loan, and description is a drop-down list that categorizes the type of funding, be it tax credits or sort of not tax credits, but home, CDBG, other things like that. So in terms of our assessment of market rates and fees on loans, when the type is a loan and when it's the description is other financing, those are other permanent capital debt that we are going to need to specifically know what the rate and the fees are on that, so that we can make a formal assessment that is within market. Thank you, Toby.
Great clarification. Thank you, Thea. I appreciate it. And so you are going to continue through all of your sources and to get to the total, and then you're going to do the same thing on your uses. And this screen, as we talked about, we are asking for a bit more detail about how you get to your acquisition cost. This is what that screen will look like. So when we say what is included in the amount and where does the acquisition number come from, we're not expecting a response like that's the acquisition cost. Is that the assessed value? Is that value based on the total of outstanding soft loans? Is it based on an appraisal? How did you get there? And are there carrying costs that are being included in that acquisition number? So please make sure you give us, a reasonable description so that we can understand how you got there. And then we're going to ask you to upload any supporting documentation that's currently available, that may include carrying costs, or it may include a projection of what you anticipate those costs to be at the time you submit your application. So AHP can be used for acquisition, it can be used for construction, hard costs and soft costs. Hopefully this isn't new information, and this is all in the feasibility guideline and in the implementation plan. But what you can't use AHP for is non-residential space, your commercial space. You can't use it to capitalize reserves or pay for services or operating costs. It really has to be the hard and soft costs, the capital in the capital stack. And you can't use AHP as a pre-development source. It can later cover some of those early architectural and engineering costs and feasibility study, but those are really at construction loan closing. If anyone on this call has a refi, I would say you probably want to talk to your SIM. We need to make sure under the terms of the AHP regulation that your project is generating sufficient equity proceeds that the AHP isn't being used to refinance the existing loan. We don't see a ton of them, but when we do, it just can get a little unclear. So if you have questions, give one of us a call.
We've got a question which is, I think, appropriate for this slide. How do you define residential and commercial? Is office space for on-site property management commercial or residential, for example?
You know, I would say that's a typical residential cost. When we're talking about commercial, it's usually space that generates revenue. You know, it can be retail, it can be service space that you're renting to someone else, to another organization, but really it's revenue generating space.
Thank you. We have another question about sponsor capacity, so I think we'll take that at the end.
So just a little bit more about the developmental feasibility and need for subsidy. So we do have feasibility guidelines that Theo was talking about earlier in the presentation. And those are all listed in attachment A of the implementation plan. What happens if you're outside our guidelines? We need an explanation, especially on construction costs. We use RS means as sort of our benchmark, and those costs are broken out based on the area where your property is, based on the zip code. If your costs are outside those guidelines, the construction costs or whatever it is, we really need a quantitative explanation as to why. And this goes back to the need for subsidy. Why are the costs higher? Why is the project overhead and profit, the builder's overhead profit and general requirements outside of the 16% guideline? You know, if a developer fee is greater than 15%, that's sort of the max that we're seeing across the New England states is allowable, and especially in the live tech developments. So if your developer fee is over that, chances are we may not allow it, and we may adjust the AHP award accordingly. If the interest rates, if you're asking for a subsidized advance and the member's loan is higher than what we see as normal, we're going to question that. Is that because this is a high risk project, or are there other reasons that this project is costing so much? And typically, you know, these are the areas, these are our hotspots when we review applications that we look at. These are the little pain points for us. So we're giving you this list to just sort of be aware, look at these with respect to our guideline, and make sure that if you need to provide an explanation because you're outside that guideline, the explanation you're giving us is clear and concise enough so that as we go through it, we're not going to have to ask for additional information. Next slide.
We got another question about residential versus commercial. If the project is permanent supportive housing with in-house social service space, can we count that as the residential space? It typically does include the fee, but that is to offset tax and insurance, et cetera.
I'm sorry, I missed the last part of it, Theo.
It typically does include can they include that in-house social service space as residential? It typically does include a lease fee, but that's to cover expenses for that space.
Sure. Yeah, that's definitely, you know, those services are specific for your residents. So I would absolutely say that that's residential space.
Right.
And we see that type of arrangement often in the supportive housing projects that we get. So it's a great question. Thank you for that. All right. So getting back to so we're on to acquisition costs, and acquisition, understanding site control and understanding where the costs are coming from are always things that we struggle with. And so we're hoping that you can sort of lead us through that. As you enter your explanation in terms of how you got to your acquisition cost, think about the supporting documentation that you're going to be providing. And it may mean that you need to give us a cover memo that just sort of walks us through. But we're looking at the cost, the documentation, information that has the same parties on it that you've listed in your site control. If you're seeking donated points, then obviously we would expect your acquisition costs to be nominal or low. And if you're if you're using acquisition costs, in the basis, then there's going to be a mismatch on how we look at these budgets. So show us the documentation that gets us to the value that you're carrying in your budget, and then give us an explanation if there's a variance or there's additional costs. And even if it's a spreadsheet with your anticipated taxes and insurance or carrying costs, that's helpful for us, because maybe the property hasn't been transferred yet. And so you're basing acquisition on what the transfer costs plus those costs is going to be. And just make it clear. Anticipate someone doesn't know anything about your project, and you're going to walk them through the steps and those numbers with the site control, the appraised value, and the total costs should all equal each other.
We got a good question about acquisition costs, and it relates to donated properties. What if the acquisition cost comes from the city and is $1 or equivalent? Can that just be explained in the narrative?
Absolutely. And if you have a letter that you're using for site control or whatever documentation you have from the city that confirms that they're going to be transferring it to you, you can upload that here as well. Great question.
Yeah, it is a really good question. You're going to include all the donated documentation as part of your location when you submit that. And what we're trying to close the loop on is documenting acquisition costs specifically. So you'll explain it again here, and you'll enter in that $1 negotiated or actual purchase price, and upload that acquisition documentation. And so that will work out very nicely. Helpful question.
So again, Thea mentioned earlier that the costs that we see in this budget have to be specific to this project. So we've added a question about multi-phase initiatives. If this is, a single phase standalone project, then your answer is no, right? And then you don't have to answer the rest of the question. But if you answer yes, then we want to make sure that it's clear that the costs that you're entering, that you understand why we're asking this, and that the costs are specific to this. And if there's things that are being spread across phases, please explain that to us and show us how that's going to be allocated. And I realize it's not a perfect science, right? These things are moving fluid developments, but you've got, most of the developers we work for have experience doing these and have done phase projects. And so you've got a framework for developing these and allocating these costs, and show us how it's being applied here. And so that we know that these costs are specific to the project you're applying for. We know it's not easy, and we know it's not perfect, and it may even morph during the development process. But at this, as I said before, pick a point in time and make sure all of that information is consistent throughout your application and throughout your budgets. So when do we have snags? When do we ask you questions? When are we scratching our head? Typically, it's when your budgets don't match. You enter information from last week and you provide us a budget from next week. And we see like inconsistencies throughout. The construction costs are higher in one than the other. The developer fees don't sync. So make sure that those all match. In the areas where we're asking for explanations like acquisition, and if something's over or one of our guidelines, give us information that helps us to understand why. I can't tell you how many applications we picked up because this is what it costs. Well, that doesn't really help us with understanding. So think about, you're going to want to make it easy for us to understand your application, understand your variances, understand your budget, because we want to fund your project. So just give us the information you need. We don't automatically assume you're playing games. We just really want to know and understand, because when one of our examiners picks up this budget and says, well, why did you do that? We want to be able to say, because right here they showed us this is where those numbers came from. I was going to say, some of the other things is, we see a number of different types of homeownership initiatives. Some of them are habitat, some of them have fundraising. And then we're looking for your cash sources and uses and your development budgets on all of these projects. It's really your cash sources and uses, and not the non-cash or donated or volunteer activities and things like that. So keep it clear, keep it concise. Don't put the commercial stuff into the residential budget and have different numbers. Separate those out. So if you do have a commercial component, that budget is separate from your residential budget, and the total of the two match what you've entered into the AHP application. So I'm trying to come up with a nice way, but make it easy for us. Here's a great example of how to give us an explanation that makes it easy. In this example, the project's costs are above the RSME guidelines for that particular area. You're coming up with construction costs of $324. Okay, this is an old example. And our guideline is $229, but it's an example. It's not necessarily today's numbers. The difference is $25. So you're above our guideline by $25. And your explanation really is as simple as, about half of that is due to Davis-Bacon wages or whatever is driving the cost in your area. A portion of that is related to historic preservation, and you're building on a ledge site. So when you add up those three explanations, you get to the $25 difference. And it's really just that simple. And giving us quantitative explanations as to why there's a difference between what your cost is and our guidelines. And hopefully that makes sense. Again, feasibility issues. We talked about the budgets not being the same. We also check, and I don't know if people realize this, we do talk to other funders. So if you're in the process of applying to one of the other funders and you've been having some conversations, but your budget with them has a completely different set of sources than your budget to us, we scratch our head. We're perplexed. Make sure that you're giving all of us the same budget and the same plan, and that we're all looking at the same project, because we do talk and we do share information. And if what you're telling us isn't the same as what you're telling your state funder, we're going to have a problem with that. On occasion, we do see turnkey projects. In other words, projects that are complete that you're buying from somebody else who developed it. They're rare, but we may get one a month or one around rather. So if you're submitting or anticipating a turnkey project, we need to make sure that the costs are consistent with other projects that we're seeing, and that your only line is acquisition. We need to understand how that acquisition cost was created, what were the hard and soft costs that got you there, and what is the supporting documentation that you can present to us, because those are often very hard for us to understand, and they're not always really transparent when you apply. So think about the transparency, think about the documentation, talk to the person that you're looking at acquiring the property from. And if you can't provide that documentation, maybe AHP isn't the right source of funding for your project. And homeownership, it's exciting. Last year we saw lots more homeownership initiatives than we'd seen in past years. And as Dan mentioned earlier, we're raising the limit of subsidy that you can apply for on a per unit basis. So one of the things about doing AHP and ownership is there needs to be a pass-through. We need to see the benefit of the sales price, that the development price less the AHP results in a reduced sales price to the owner, to the buyer. We need to see that it's affordable. So we do this really cool worksheet where we can see what your cost per unit is, what are the subsidy sources and other, AHP and other subsidy sources that are reducing the sales price. What's the term of that mortgage? Is it, an adjustable? If it's an adjustable, is it fixed for a reasonable period of time, or is it a fixed rate? Which is ideal that, so the actual mortgage payment hopefully gets smaller to the family or the buyer over time. And if you're a Habitat, are you providing a zero first rate mortgage, or are you doing some sort of other layering that allows the member to make a first loan or RD to make a first loan and you're providing a soft second? If you're a Habitat and providing a first mortgage, then our regulation requires us to discount that first mortgage if it's a 0% mortgage to the buyer. So all of those questions, I would say, think through your project, what makes sense. You can't do a blend if you're a Habitat. It's either going to be all zero interest rate first mortgages or projects where you're providing a soft second. So if you've got a funky model that we haven't heard of and you're a Habitat, I would say reach out to your community investment manager and make sure we just understand so that we can coach you and help you figure out the best way to enter that information. Because if you are doing a zero interest mortgage, the application is going to actually calculate how much subsidy you're eligible for. I'm not sure if we said this at the beginning, but as you enter the AHP application, you have to choose if you're a rental or ownership initiative. That's like the most important choice you're going to make, because based on what you choose there, the application is going to lead you down a path. So if you're an ownership initiative, make sure you click that button right off the bat, because otherwise you're going to have to start a new application. And we don't want you to be frustrated, but we just want to help you make the right decisions as you go forward. So again, addressing habitats, we want to see your hard and your cash sources and uses separated from your in-kind sources and uses. So there's a line that you can include your in-kind, but there's also the actual hard costs, and those are the ones that we're going to be evaluating. And again, if you're doing a first mortgage at 0%, the application is going to calculate how much you're eligible for. It's a little bit of a funky numbers game. And if you get stuck, Kathleen is awesome at these. we all struggle, and we will all help you. But yeah, it's a little tricky. We know it is, and we apologize. But we didn't make this up. I know that we're going to work with you and help you figure this out. All right, well, I think I am now going to turn things over to Mike if there's not any questions specific to that section.
Yeah, we have some other questions, but we'll catch them at the end.
All right. Well, thank you, everybody. I'll pick up here and kind of zip through the last few slides that we have and leave some time for questions. And then everybody can get on their day. So here, Toby mentioned that we have a cool little worksheet for ownership, and this is it. You can use AHP for construction in order to reduce the sales price, or you can use AHP as down payment assistance. Either way, the end result's going to be the same, a reduced purchase price or reduced mortgage amount to ensure that the home is affordable for your buyers. And on this worksheet, you'll see that each column is a house type, meaning bedroom size and income targeting. So if you do the math right, you won't get any error messages. For example, this is a 2-unit habitat application. You can see the cash TDC per unit, AHP per unit, actual mortgage amounts, and the 0% rate and 30-year term. So, often, we'll see some errors on this, and you'll be able to just follow your math and identify what's going on there. On the next one is the affordability calculation for rental. This is where you're going to enter the rents and the total rent and tenant payments. You're going to split the units if you need to break out the units of some income targeting levels, bedrooms with different rent structures. You can enter 30, 50, 60, or 80% area median income and market rate units. So the text you can see will explain with this screenshot, and we've got some help items there, I believe. We don't on this section. Next one is the operating summary statement. This is where you're going to enter your first full year of operating data from your residential operating pro forma. We're going to talk in a second about using the bank template for this section. That's really important. We can't stress enough that you must use the bank's operating summary, 15-year operating pro forma. The application draws directly from the fields in this. We no longer will accept pro formas from other funders or your own in-house pro formas. You must use our template. Otherwise, we're going to have some issues with your application, and we may be forced to set it aside. If you have a commercial component, provide a separate commercial-only operating pro forma. If you have commercial space, income, expenses, etc., all the normal fields are here: income, expenses. You're going to have a gross rent override if the gross rents are not calculating correctly based on the total rents in the affordability calculation screen. You also have a debt service override field if the total cash and senior or primary debt debt service is not calculating correctly based on prior data entered. Okay, so next one. On the rental operating data and pro forma, again, here's our template. It's really easy to follow. You're going to enter all your rents and everything on the affordability calculation screen, the operating summary statement screen, and then you'll come to this, the operating pro forma, the template you'll pull from the application. You're going to enter data only in the yellow fields. Like I said, we don't accept pro formas from other funders or your own internal sheets. This reduces the greatest number of errors that we would have in an application prior to this template being introduced a few years ago. This template is something that we are going to be following through also throughout the life of your project. If you get funded, we're going to be looking at your operating data at the time of disbursement. We're going to be looking at it at closeout. and periodically throughout. So this is something that you need to keep updated and keep using. Please don't do it one-off for the application and then think that you're never going to need it again, because we will need this again. So pull this off of download the template. The template matches to the operating summary statement in the application. The yellow fields are editable. The formulas are all automatic. You're going to enter the annual income and expense inflation factors separately. Enter your first full year income and expenses, and it'll inflate automatically. This is for residential data only. If you have commercial units, you'll have to upload a separate pro forma. And then column D has instructions where this data matches to the operating summary statement. The pro forma template, it's designed to help you arrange your operating data so that you can successfully input this data into our online application. We have some key points here. Management fees are not to be included in your subtotal of housing residential operating expenses. These are separate and must be entered into the operating summary statement. They're not going to be part of all other operating expenses, part of the subtotal for all other operating expenses. The operating reserve and replacement reserves are also separate. Management fees will be included in the total operating expenses, and the operating reserve and replacement reserves will also be included in the total operating expenses. So please be sure, again, you're going to be using our template. You really don't have an opportunity to not break this out, but we need to see that management fee. We need to see these reserves. And also often we have folks coming up with various forms of reserves. We need you to be very clear as to what is what's going to be an operating reserve and what's going to be a replacement reserve, because sometimes we have folks that try to break out different reserves that really should fall under one bucket or the other. Okay, so the rental operating data and pro forma. The operating pro forma template has the functionality built into it to calculate the net operating income and debt service coverage. That's line item 1. Cash flows, item 2. We also calculate 2 formulas. Cash flow is a percentage of effective gross income, and cash flow is a percentage of net operating income. We calculate these along with the debt service coverage annually for years 1 through 15 to show trends. So this is one of our big review items as we're looking through your feasibility in the application. On item 3, you'll see we have a separate section at the bottom of the template to track cash flows into reserves. This will calculate the ending balance of the capitalized operating reserve, which must be entered into the online application. So we've really taken a lot of the guesswork out of this. We're making sure that you give us the data that we need to assess your feasibility. Please be very clear about what you're entering into these fields. It's going to make our review much easier, much faster. We are willing to clarify feasibility to a certain extent. However, if we find ourselves in situations where the sponsor is not giving us the right answers quickly enough, or the data that you're giving us just doesn't add up, we will set your application aside and remove you from the round. So keep that in mind. Make sure everything really adds up here. We've really found this template to be useful for sponsors, members, and for us, and it's resulted, in saving numerous applications from sponsor errors that we used to see. Next slide, please. So operating data on residential services. As part of the pro forma in the operating summary statement screen, we're going to need you to separately list any resident services as the annual dollar amount. It's the same line in the pro forma for the first full year, and describe these services. We're going to calculate the housing operating costs and net resident services on a per unit per year basis. So the range we're typically looking at is $6,000 to $10,000 per unit per year. And deviations outside of this range will need to be fully explained. So as Toby was discussing, our feasibility guidelines are in fact guidelines. They are not necessarily hard and fast thresholds. However, if you find yourself on the low end or the high end of the guidelines, outside the range, we absolutely need quantifiable data. We can't have you just say it is what it is. We understand that a lot of these costs are what they are, but we need to know why those costs are that. Please explain it. Make it easy for us, because not only are we looking at these applications kind of from the outside, we're not familiar with your project. We also have our own examiners that will be looking at this project and truly have no idea what your initiative is. So we need to spoon feed data to the folks looking at applications to make sure everything ticks and ties with our guidelines and what we're looking at. So for operational feasibility on rental, it's the same idea as developmental feasibility. Data and documentation, we have heard it time and again. We need the data and documentation to confirm cost reasonableness and need for subsidy. So look at our feasibility guidelines. The implementation plan is going to be the document that you want to have handy throughout this process. Have the March 2023 implementation plan out, and that will explain exactly what we're looking for on scoring and feasibility. And if you find yourself outside of the guidelines, that's what you need to look at and justify it. We often get into problems when the data is match, unclear or inconsistent trending, negative cash flow, super high debt service ratio, or a high positive cash flow. So bad, unclear, or incomplete information prevents us from determining need for subsidy, cost reasonableness, and to make sure your project is not over subsidized. So just keep that in mind. If you see yourself in a situation where these trends are out of line, or you're starting with a super high debt coverage and it's dropping down, explain why. Again, these are guidelines, but we need to know why. So on the final pages of the application, we do have some issues where you'll explain any of the feasibility deviations. It'll pop up here. Completely, concisely, quantitatively address these issues. Really high deviations will require a thorough quantified explanation and may require additional documentation. As we've said throughout, make it easy for us to follow what you're talking about. If the supporting documentation for one of the feasibility areas is a 150-page document, give us an executive summary. Give us a paragraph that explains what you're looking for. Don't write a novel, because that also will get lost in that amid the dozens of applications that we're going to be looking at. Be clear, concise, but make sure you hit all the points that we're looking at. The application will validate the data to make sure no required fields are missing and there's no inconsistencies in the data that you've entered. This will help ensure that the full application is submitted. The application does take time. The way that our questions are set up are such that if you know your project and you're familiar with your project, you're going to be able to answer these questions. We don't rely on extensive narratives or anything like that. Pick that point in time, as Toby noted, for all of our questions. We know that these projects are evolving, that you're coming to us potentially early in the process, and that your numbers will change, but pick that point in time for all of your data with all of your funders to make the review seamless. And last but not least, after the sponsors submit their applications on July 27th, we do have a week-long member analysis period. Sponsors at that point will no longer have access to the application. If you complete early and submit it to your member before the 27th, they can always look at it and unsign it, send it back to you to make edits. But as of 3 o'clock on the 27th, sponsor access is cut off, and the member cannot enter new data for the sponsor. They can only make comments on it. So keep that in mind. As Toby noted, please, every year this happens where we have sponsors panicking at the last minute. they run into technical issues, they have too many people working on the application because you can only have one person at a time in the application. Plan ahead, have this done a week ahead of time if you can, or at least, you know, as far ahead as you can, because we cannot guarantee that we're going to be able to resolve any technical issues. If you lock yourself out of your application at 2:50 on the 27th, that, you know, there's a good chance we won't be able to help you with that. So the sponsors submit on the 27th. Members can then complete their portions of the application. They're going to enter all of the funding data, term sheets, that sort of thing, complete a member analysis. They're going to upload any sort of underwriting that they have, commitment letters, and members are going to explain any deviations in the rates and origination fees being charged on their loans to this application. So, you know, a big part of this is market rates and fees. So members will explain a fee greater than 1% of the loan principal, and you know, anything that exceeds our application benchmarks. A few key reminders: proof everything. That's you know, a critical component of this. Our biggest, one of our biggest pain points is with site control and donated documentation. Confusing or hard to follow documents are often what will sink an application, whether it's not proving site control or not getting the donated points that you relied on. Give us that executive summary. It's really, these are, you know, we have some easy ways to gain points and easy ways to lose points. If you don't use our templates, don't provide the right template for empowerment or MWBE inclusion, if you don't use our operating pro forma. These are you know, easy areas to miss. So just please proof everything. Sponsors, you're going to enter the members' lending and investment data into this project when you fill out the request for funding sections. But it's critical that you enter this data correctly, including the loan amounts, rate, term, amortization, and origination fees. This is often an area that we find ourselves correcting. And again, you know, it can result in a loss of points. It can result in you getting your application set aside. Our scoring and our application are designed to be transparent. We want this to be something that you can self-score your project. If you are entering all the data correctly, have somebody in your organization that may not be familiar with the project look at it. Make sure you know, an outside viewer sees what you're seeing, and you're going to get the score that you anticipate. That's how it's designed. There's no guesswork behind it. But you know, you need to give us the information that we need. And last but not least, if you have questions, reach out to us. We're here to help you. You know, we're going to be around. If one of us is out or something like that, give another one a call. You know, we all work together on these projects, and we want to help you, you know, bring these to a successful conclusion. You know, whether or not it's the application or ongoing after you're funded. And again, the implementation plan has been updated as of March 17th, 2023. If you have an old version, delete it. Get the new one off of our website. That's what we're going to be looking at in the project. And with that, let's quickly move on to some questions.
Yeah, so real quick, just to clarify the total subsidy per application and the direct subsidy grant. Total subsidy is 1.2 million, and that's a combination of direct subsidy plus any indirect or interest rate subsidy that's folded into the subsidized advance. So we call that advance subsidy. The maximum amount of direct capital grant in that 1.2 is the 850,000. So that would leave 350,000 of potential interest rate subsidy if you took the maximum grant. We got a number of questions about uses and then some operating costs. Do you guys want to read them, or do you want me to read them and then you can answer? All right. This is in terms of acquisition. Are due diligence expenses such as geotechnical and environmental investigation included in acquisition costs? That's a question for Toby.
Great question. I think typically we see those going into soft costs or other costs, but I think if whatever program you're using allows you to carry those into acquisition, we would just need to understand the breakout. Again, I think we would typically see them under one of the other pre-development costs. So, but we're happy to work with whatever source you're working with, and as long as we can understand the breakout.
Yeah, all right. If the property is acquired by a grant, do we exclude that grant or count it as leveraged money? And that's a sort of an acquisition, donation, sources question.
I was just going to say, it would really depend on how your other funders are going to be looking at that, and if this is going to be part of your project's TDC and part of your acquisition costs that you're leveraging. We just want what you show us and what you provide to us to be consistent with what you're doing with other funders.
Yeah, that's the spot on answer. If there's space in the building that could be argued or cataloged as commercial but doesn't generate revenue, can we use that explanation to say it's residential?
I think it would really depend on what the intended use is, right? Is the space there to provide services to the residents, or is it something else entirely? I guess, at least my view on this is that it's, kind of a case-by-case basis. It's hard to differentiate in a bubble without knowing the entire project. But if anybody else has any thoughts on that.
Yeah, no, I think that's right, and that's really helpful. And I think Toby's answer is certainly how the other funders are also categorizing that space is helpful as well. Another acquisition question is, what if the acquisition cost is the sum of outstanding debt, including amortizing and soft debt, from an old tax credit project that's now being resyndicated and rehabilitated? How would we view it, particularly if it's below both the tax assessed value and the appraised value? So
the questions I would have is, what are you going to use for acquisition basis in your LIHTC application? Is it going to be that remaining soft debt, or is it going to be based on the appraised value? And I think we probably need to have an offline conversation with you about your project just to better understand.
Right. But that's in fact why we have this separate acquisition screen, because it will allow you to clarify what that use is, the dollar amount of the use, and the components of that. So I think that would be very, very helpful.
It's just a question here about our guidelines. The guidelines are actually based on location. So what we had in the presentation was just an example of $299 per square foot on the construction costs, hard costs. It'll be keyed into that location that you enter at the very beginning. The application, just note, it builds on itself. So please, at the very start, you're going to obviously first determine if this is home ownership or rental, but then you're going to quickly move into location. Do not change your location after you enter it, unless you want to redo your application, because it's going to affect a lot of different screens. including the guidelines. So please make sure you get the location correctly at the start, and that will help set the guidelines. So it does vary depending on the location.
That's very helpful. There's a habitat question. If we're not providing seller financing, can we still apply for a homeownership project that will be sold at affordable prices to income eligible buyers?
I think my immediate take, this is Toby, is that's great. Your application will be so much easier. And we're excited to talk to you if you need some help, just sort of thinking through that screen that Mike showed you.
Right, and yeah, if you're not providing zero or discounted financing, you're going to fill out the member funding slide tab. You're going to fill out the sources tab and include the permanent debt in those spaces, and move on from there.
I had a question early on, Theo, about sponsor capacity, where there's been a lot of turnover and some issues with the sponsor, leading to some delays in their audits, and what they can provide us in terms of on the sponsor registration and documenting sponsor capacity on the application. If you want to just kind of touch on, Theo, like, you know, what we'll be looking for, would a sponsor in this situation meet eligibility requirements, that sort of thing?
Sure. You know, we are going to, again, it is about the sponsor demonstrating that they have the development expertise and the capacity to get the housing built, and be able to own and operate it successfully, depending on the project type. In this kind of question, given that there's a lot of turnover, there's going to be a lot of opportunity to describe and document that turnover and how that turnover has been resolved. You are going to need to provide resumes of the key development staff, and that would go a significant step towards demonstrating current developmental capacity. We're going to ask questions about the board and board capacity and board quorums. How often do they meet? This may also be an opportunity for this entity to partner with another known developer to help shore up those questions of capacity that we would have, that the member might have, that other funders might have. Yeah, and in terms of delays in providing audited financials, both ourselves, the member, and other funders are going to want to see the most current information that's available, and I would imagine want to see the information when the audit is complete, and that could potentially be an award condition. I think it really depends on the specifics of the issues and the delays. So, but you have the opportunity to provide management prepared documentation or draft audits or things like that. You know, as long as you are clearly acknowledging sort of the circumstances and that the financials are delayed. So there's no reason why on its face that the sponsor wouldn't be eligible to apply for AHP.
And that kind of touches on to our view on when you reach out to us for help. What we're going to be doing is pointing you to the implementation plan quite often. Especially if you have a question about scoring, we're not going to be able to tell you now if a project will score on a certain area. Again, we make our categories as transparent as possible. Obviously, with sponsor capacity, as Theo noted, there is some wiggle room in there. But it's hard for us to look at anything kind of in a bubble without having the entire application and everything in front of us, whether it's scoring, feasibility, capacity, that sort of thing. Couple other quick questions here, probably for you, Theo. Will this PowerPoint be available, as you mentioned earlier? And then also, do we have a checklist or any sort of list for all of the forms and templates, and where's the best place to get them?
So the PowerPoint as a PDF is one of the handouts here, and I will also be emailing it to all the participants today. We do not have a checklist per se that's available at the start of the application. The application does track all of the required exhibits, and so that's certainly a good source to begin with. But you know, as you step through your application, you'll be able to see what forms are uploaded, what's missing, and it does include all the various elements of the online application. You know, so it would be the scoring documents, the donated or the site control, as well as the budgets, the operating pro forma, in addition. So the online application really has the, I think, help topics, and is really designed to help you track your own progress in filling out the application.
One last question. Go ahead, Toby.
I was just going to say, you're also going to be prompted to answer and provide information for any out of range conditions. So you can always look at what you uploaded and making sure that you've cleared all those validation issues.
Right. That's a really good point too.
Looks like we have just one last question here. Can you monetize the cost of services for a nonprofit social service provider with whom you have an MOU that's billing Medicare or similar, and not passing the costs along to the project? What if the project isn't paying the bulk of resident services?
So if the services are off budget, then I think they're going to be off budget. I think the other way to do it would be, if you're including the total amount of these services, then you would be listing this Medicare funding as other income in your income up above, so that they really are netting out, or netting out as much as possible. And then, you know, and then you can see that the project itself is using some of its rental income to pay for the resident services that you as the sponsor are providing, as opposed to Medicare. And I think that also speaks to the follow-up question about what if the project isn't paying the bulk of resident services. Let me know if that. Let us know, rather, if that was an adequate example.
All right, just a couple other quick questions here. A link to the online application. Everything is going to be accessible through our website, housing.fhlbboston.com. You're going to need a user ID and password. So request that today. It's a manual approval on our end if you're a new sponsor, and you'll need to go through the approval process that way. And then also, in terms of you know, starting the application and kind of getting ahead of partnering with a member, the application is really set up to, we really value the role of the member in the process. It's critical to have the member involved early. You know, they are our kind of eyes and ears on these projects. They know the project better than we do. So as such, we don't let you start your application until you have a member partner lined up. So you're not going to be able to get to those forms or anything like that that are part of the application early. The templates, they really aren't that hard to fill out, though. You know, you should be able to turn those around pretty quickly. it kind of in line with a lot of our other responses where it's short and sweet. You know, if you're going to be discussing your empowerment and community stability items, things like that, it's, you know, we're looking for very short bullet points here. It doesn't need to be a long narrative or anything like that.
Right. Specifically, the empowerment templates are on our website and can be downloaded. So.
Oh yeah, I was thinking about the list of everything and everything like that. But
Yeah. The operating pro forma is embedded in the application. The affidavit for for the inclusion category for those for-profit development partners is embedded in the application though.
I just wanted to also give folks the where they can get to the online application into our portal. If you go to the bank's FHLBBoston.com website, you'll see a green login button. If you click on that login button, you'll select community lending, and that'll bring you to the screen where you can request credentials or log into the system to access your projects or applications. So if you didn't catch that address that Mike gave you, just go to the bank's website and click the login button.
It really comes down to web links and knowing where to go. So that's a really helpful answer. So thank you, Kathleen. Well, this has been really valuable for us, and I hope for you. We really appreciate all of these questions.